The year is 2026, and Silicon Valley is gripped by a gold rush. Billions are pouring into startups, promising to revolutionize everything with artificial intelligence. Headlines scream about exponential growth, trillion-dollar valuations, and disruptive technology. But beneath the surface of hyper-optimism, a dangerous fragility is taking hold. This is the story of the AI bubble, an economic phenomena echoing the dot-com era's greatest mistakes. We are unmasking the factors driving valuations to unsustainable heights. And we are asking the critical question, is Silicon Valley headed for its next catastrophic crash? The core of the bubble is fueled by three interwoven factors. First, the immense capital influx from venture capital VC and institutional investors. These funds are desperate to find the next NVIDIA or next Open. They are deploying capital at unprecedented speed, often without adequate diligence. Second, the technological hype cycle, which consistently outruns real-world commercialization. Every company claims to have solved AGI, artificial general intelligence, or at least a powerful component. Third, the massive centralized costs required to run and train these AI models. The industry is overwhelmingly reliant on a few chip makers and a few cloud providers. This creates a critical bottleneck and a hidden dependency across the entire sector. If you recognize the risk inherent in this technological gold rush, please like this video and subscribe. Your support helps us deliver critical financial and technological analysis. Let's look closely at the valuation problem, the key indicator of a bubble. Many AI companies are valued based on potential users, not current, reliable revenue. They have high burn rates, consuming massive amounts of cash just to keep the models running. The cost of compute power required to train a foundational model is measured in the hundreds of millions. These companies must continuously raise larger and larger rounds just to survive the training phase. The revenue models are often theoretical. We'll figure out monetization later. This is a direct echo of the late 1990s, where eyeballs were prioritized over profit. The crash won't begin with a single event. It will begin with a simple lack of liquidity. The system breaks when a major, highly valued startup fails its next funding round. Suddenly, investors will be forced to reevaluate the entire sector's valuation assumptions. This correction will cascade, hitting every company that relied on optimistic growth projections. The second, hidden layer of the AI bubble is the compute oligopoly. The entire AI revolution is fundamentally dependent on a few companies: NVIDIA, Amazon, Microsoft, and Google. These companies control the chips and the cloud infrastructure needed to deploy large models. They are not in the bubble. They are the gatekeepers who profit regardless of who fails. The AI startups are essentially paying rent to the giants, creating an inverted profit structure. The AI startups have little pricing power and immense operational costs imposed from above. The risk is centralized, but the cost is spread among thousands of startups. The crash will expose the vast distance between hype and sustainable margins. The sector is currently suffering from a talent wage bubble as well. Salaries for top AI researchers and engineers have reached unsustainable heights. This high fixed cost makes it difficult for new, smaller companies to ever achieve profitability. When the funding dries up, the talent will be the first and most expensive line item to cut. What are the signs that the unmasking has already begun? Layoffs at once high-flying mid-stage AI firms are becoming more common. Venture capital funds are starting to shift from seed funding to survival funding for existing portfolios. The focus is slowly moving from disruptive potential to actual cash flow. This signals the beginning of the inevitable market flight to quality. Only companies with proprietary data, defensible margins, and clear customer value will survive. The rest of the Me Too AI wrappers and non-core applications will rapidly disappear. The AI crash will be brutal, but ultimately necessary for the industry's health. It will clear the field of unsustainable ventures and redirect capital toward genuine innovation. The technology itself is real. The business model surrounding the technology is often pure fantasy. The next wave of AI success will be defined by capital efficiency, not endless spending. Surviving companies will be those that master optimization and smaller, specialized models. The untold story of the crash is that it benefits the consumer in the long run. It forces companies to deliver tangible, affordable value rather than simply raising money on a vision. We must look past the buzzwords and examine the financial statements with skepticism. The AI bubble is not the end of AI, but the painful, cleansing start of the real AI industry. We must prepare for the inevitable market correction that separates the giants from the ghosts. The clock is ticking toward the moment the market demands real returns on its massive investment. The unmasking is coming, and only the truly resilient will survive the shockwave. Share this video to start a critical conversation about the true cost of the AI revolution. Help us shine a light on the financial risks hidden within the technological euphoria. We will continue to track the signals and analyze the shifts in this critical sector. Thank you for watching this deep dive into Silicon Valley's next potential crisis.